Hello, I am Bailey Thompson, Senior Associate in the Sustainable Finance team here at the London Stock Exchange, and welcome to today's webinar exploring how listed energy and resource companies are adapting to a rapidly evolving landscape and continuing to meet stakeholder expectations, while also navigating strategic and operational challenges in the energy transition. Just some quick housekeeping before we begin. This session is recorded, and anyone who wants to watch again or share with any colleagues can do so by revisiting Spark Insights, where this webinar will be available as a video on demand going forward. This is designed to be an interactive session, so we do encourage you to ask questions using the functionality built into the platform. You will see the Ask a Question option on the right-hand side of the video player on your screen. The questions will come to me, and I will then present them to the panel throughout the session. Thank you for joining us today, and with that, let's get started. Firstly, I would like to invite our panelists to introduce themselves and their companies to the audience. Perhaps Paul will start with you.
Thank you very much. Good afternoon, everybody. My name is Paul Blythe. I'm a partner at Crow UK. I'm head of energy and natural resources at Crow, and also a partner in the corporate finance team. For those of you who don't know Crow UK, we are an audit, tax, advisory and risk business, employing over 1,600 people. We have 107 partners. Annual turnover for us last year was 184 million. We're very proud to be part of Crow Global, which is a top 9 international accounting firm across 150 countries, employing 42,000 people with annual turnover of 5.8 billion last year. So very pleased to meet you all.
Oh, very impressive. Harry, can I hand over to you to introduce yourself?
Hi, good afternoon, everyone. My name is Harry Cameron. I'm a Senior Managing Director at Teneo. Teneo is a global advisory business spanning financial advisory, management consulting, people advisory, and strategic communications, which is where I sit. I co-lead our industrials team here in London, and I've spent the last nearly 20 years advising companies across the extractive industries and broader industrials sector on financial and investor communications.
Thanks, Harry. And Artem?
Thank you. I'm Artem Volynets. I'm founder, chairman, and CEO of ACG Metals Limited, a company listed on the main board of the London Stock Exchange. I spent about 30 years in mining, mostly buying and selling mining assets and companies, actually mostly buying. And that's what I'm doing now with ACG Metals as we look to consolidate the copper sector through a series of roll-up transactions. We currently have an asset in Turkey that we acquired in September of last year, generating about $75 million of free cash flow this year, moving from production of gold into production of copper to generate about $100 million in free cash flow just from this asset as we move to the full production of 25,000 tons of copper equivalent. The vision for us is to build a large global copper company producing 200,000 to 300,000 tons in the next 3 years or so, to start with.
Thanks, Artem. I look forward to hearing more about ACG Metals in the session going forward. And last but not least, James?
Yeah, thanks very much for hosting me, and a pleasure to join such a accomplished panel. I'm James Rogers. I'm the CEO of Cayenne Copper. I'm an exploration geologist by background. I've been active now in the mining industry for 16 years. My specialty is on early stage exploration, project development, and currently running my own capital, searching the world for new ideas with an emphasis on copper. As CEO of Cayenne Copper, we're doing just that in Southeast Asia, where our flagship project is in Malaysia, where we're advancing an early stage high-grade copper opportunity.
Thanks, Jane, and thank you all for joining us today. So it's no secret that energy demand is rising sharply around the world, driven by the growth of AI, automation, and electrification. In parallel, geopolitical tensions have highlighted the importance of energy resilience. In response, global energy policy is evolving to not just address climate goals, but to also ensure energy security and economic competitiveness. Globally, governments are now viewing the energy transition as a strategic priority. So, Paul, Are you able to dive into a little bit deeper into how the current political landscape is influencing the UK government's approach to energy security and the energy transition?
That's a nice, easy question to kick off with. So I think in the UK, where we sit at the moment is, I think the key word on everybody's lips is uncertainty. What does the UK framework look like? I think for people investing in the sector, they're looking at assets and projects that last many, many years, sometimes at least 10 years for some, possibly longer if you're looking at nuclear. And for somebody coming into those sorts of projects to invest in an uncertain climate, it's not really where you want to be. So where are we in the market at the moment? You have the current government in the UK, Labour. They are behind their net zero 2030 and 2050 targets, which is great news. We have on the fence, we have the Conservatives and the Liberal Democrats rowing back from their commitments for 2030, 2050. And then we've got the new horse in the race, Reform, which is taking a lot of the, I suppose, the ideas that are being pushed across from the US. So they've publicly stated that they will rewind a lot of the net zero targets that we have in the UK should they come to power in the next general election. They're leading the polls at the moment, but whether they come to power or not, we'll have to wait and see. So between those three horses, or four horses, but three camps, those really are producing this uncertainty at the moment. Now, if Reform come into the play, possibly not. But what they're all already doing is putting more uncertainty into the market by saying, if you are applying for AR7 this time around, guess what? We're going to come into power and then remove those rights and assets. So just watch your horses and watch those investment plans at the moment. So again, that's something that they are influencing as we sit here today in the current climate from outside of number 10. So back into the US, if we take a view up from the UK into the US, that's a very clear drill baby drill plan. Mr. Trump has been over in the UK quite recently, speaking to the King, speaking to Mr. Starmer, and saying, look, you've got a great asset up in the North Sea, use it. It's got lots of energy there for you, good security. Why don't you use it? So whether those comments recently made fall on the ears of number 10, I guess we'll have to see. In the US, following on from that, we've just had the Net Zero Banking Alliance disbanded, formed in 2021. You've had the big hitters, JP Morgan, Goldman, Bank of America, HSBC and Barclays in the US all removed themselves from that alliance, and it was disbanded in a week. So again, it's the US removing itself from the net zero carbon commitments that have been made. A little bit further afield, a personal note, I was just in Ghana earlier in the month, and their message really coming through from that conference was hey, look, we've got an awful lot of assets, fossil fuels and carbon sitting on our doorstep. We have the technology to produce them and use them. Unfortunately, we have lots of population and lots of people that don't have access to day-to-day electricity, hospitals and schooling. And so we've got to get moving, and we've got to get moving quickly. So their view very much is, let's use the assets on our doorstep and get the country and indeed the wider West African region powered up. However, they've also very quickly said, we recognize the renewables play, we recognize the transition that's needed, and they're working on both avenues together. So coming back to the UK, I think the popular consensus who's going to win in the end is going to be somebody or a plan really that sits in the middle. The UK needs base power, so that's it's traditional fossil fuels. We have Shell just bringing on its Victory asset in North Sea, 900,000 homes being powered from that, which is great. Going forward, where are we on nuclear? Base power is needed. Moving on to the renewable side, the wind and the solar, the storage, the CCS and hydrogen, all very important plays, but they'll take a little bit of time to bring on and enable the UK to meet its current energy needs. I think the latest stat I had was that the renewable side, that's the wind and the solar, this year to date has powered the UK for a number of 87 days in total. So work to be done, but it's progress.
Thanks, Paul. And of course, it feels at the moment you can't have many conversations without talking about the upcoming budget. Can we expect any energy-related announcements in November?
I'm hoping that we can. It's probably worth just taking a step back, actually, and thinking about the commitments that the government have made already. So we've got a big commitment on offshore wind. 1.1 billion has been mentioned and plugged into predominantly northeast. Associated port facilities, 134 million into those as well. We have green hydrogen projects coming on stream, UK producers, which is good news. We've had commitment from the government to support 2 large CCUS Track 2 facilities to the tune of 9.4 billion. Acorn, which is a Storegga Shell play, and Viking, which is a Harbour BP play. So lots of renewable commitments there from the UK. It's also on the core power, the nuclear. Sizewell C has been commissioned with 14.2 billion for that. That's a very sizable number. And a commitment also for the smaller end of nuclear, small modular reactors, 2.5 billion. So it's good news for the energy. I think home efficiency coming down to individuals, both at home, lots of heat pumps, solar panels, batteries, installation, etc., has been targeted and funded by the government, 13.2 billion for that. And then transport decarbonisation, again, for 2.6 billion for EV uptake and charging infrastructure. All of that wrapped up with GB Energy being commissioned 125 million to move up into Aberdeen, albeit a lot of people are still down in London. Watch this space. So with that said, that's the backdrop. What can we expect in November? I think what we're looking at are probably 4 key items. We have a carbon pricing and emissions levy, which could align UK carbon pricing to those in the EU, and potential new levies on industrial emissions. So that's point 1. Point 2 is our good old friend, the emergency profits levy in the North Sea. Is that going to be extended and or adjusted? I would have thought both, to be honest with you. It's a good cash cow for the UK, but it's bad news for those people that are looking to invest in the North Sea. The other point to that is investment offsets may be targeted as well as a tax reduction. The next item could be electricity generator levies, which is actually a positive. So that may well extend the renewable energy producers that are captured by that, which will be good news. On the slight downside, there may be a tiered system to differentiate between legacy assets and new assets, obviously with encouragement to bring new assets on stream. And then the final piece that we may well see is the green investment incentives. And these are enhanced capital allowances to encourage companies to invest in the energy transition sector. And things there that we may see included are battery storage, green hydrogen production, offshore wind, and CCS. So hopefully we'll get some decent news on the 26th of November at the budget.
Yes, there's certainly a lot to keep your eye out on. Harry, Paul has covered the political angle and touched on slightly the attitudes of some banks in the US. But if at all, how has the investor view on the energy transition changed? Are there any particular trends in investor attitudes, say looking at renewables or particular regions? I know Paul mentioned the North Sea.
I think it's a really interesting question. It feels at the moment like everything you read, there's this sort of growing policy headwinds against the energy transition and renewables. But I think every survey that I see on the sector and people that I speak to, I think there is a broad consensus still that the energy transition is coming. I think something I read recently, like 70% of investors see it as an unstoppable force. And I think a similar amount, around 70%, also saw opportunities for investment there within the energy transition. However, there is this fundamental tension around the energy transition on when are you actually going to get those returns on your investment compared to more traditional fossil fuels or others? We've seen things like hydrogen, for example. There's been lots of investment around green hydrogen over the last few years. However, that market appears to be moving right. And where some people have made the investments in it, it's now looking less attractive because the market for those end products is not necessarily developed in the same way that people thought it might have done sort of 12, 18, 24 months ago. So again, there's that thought of the energy transition is coming. However, the speed of it seems to potentially be up for grabs. And again, on Paul's point, I think political headwinds and also the uncertainty around legislation, not just just globally around it, has been quite unhelpful for people when thinking about investing within the energy transition. I think we've seen practical examples of this as well, particularly with the oil majors, where they've significantly curtailed their investments in renewables and greener fuels, in favor of continuing to drill for oil. And I think if you look at, depending on who you believe, peak oil demand is somewhere between 5 and 25 years away. We're going to need a lot more oil. And I think there's perhaps a growing recognition of the key role that oil and gas will play in the energy transition. I think if you look at the North Sea in particular, there is hopefully a growing recognition of that, but I still think there needs to be more in that front. To Paul's point about the energy profits levy, I mean, that is a tax at the moment when there are no windfall environments around current oil prices that is seeing a mass exodus of jobs within the North Sea at the moment. And if we want an energy transition within the North Sea, most of the workers that we're going to need to do that, the skills are currently in oil and gas. And if we can't support that industry currently, I think there are questions around, will we actually be able to, things like CCS, wind power, offshore wind, we need to repurpose those jobs as part of a sort of just energy transition, that with oil and gas and fossil fuels continuing to play a part of it, if we're actually going to be able to deliver a sustainable, I think, green transition here and really invest in the future in this country, in those regions. Because I think in the UK in particular, the skills that we need, some of them are here, some of them aren't. But if we're going to be able to develop it, we've got to have the right skills in place. I think that's a particular challenge at the moment.
Thanks, Harry. I think that's one thing that I think is for certain amongst all the uncertainty, that there is some form of energy transition, and it's more the pace of the energy transition which remains uncertain. Artem, in this session, we have focused very much on the energy landscape, but I'm interested to know how that also links with critical metals. So are you able to explain what this landscape means for critical metals, and explain how materials such as copper are crucial for electrification and renewable infrastructure, which are key parts of the energy transition?
Sure. Copper specifically is blessed with a very wide end user base, which goes from traditional industries such as construction, grid, wiring, military spend in defense. Ammunition shells is nothing less and nothing more than lots of copper. To the new industries such as EVs, offshore wind turbines, and the data centers for the artificial intelligence. Right? The energy transition may speed up, may slow down, but it will not change the simple fact that one electric vehicle uses 4 times copper versus traditional one. So traditional petrol engine car will have 20 to 25 kilograms of copper. The electric vehicle will have 80 to 100 kilograms of copper. So which means 1 million EVs will need 100,000 tons of copper. If you believe the projections that in 2025, this year, global EV production is 20 million units, and by 2030, which is in 5 years, it will be 45 to 55 million units. That means at the minimum additional 25 million electric cars, which means additional 2.5 million ton of copper. And that is about 10% of the current global demand. If you look at the offshore wind turbines, the numbers are the same. Onshore wind turbine need 2.5 to 4 metric tons of copper. Offshore, 8 to 12 tons, so again, 4 times as much. The projected demand from offshore wind turbines for copper is 1 to 3 million tons by 2040. If you look at the data centers, and I'm not talking about any other industry, assuming everything else doesn't grow. But if you look at the data centers, there are projections that the current investment in the data centers will lead by another 2 million tons of additional demand by copper by the same 2030, which is in 5 years from now. So all in, if you add just these 3 sectors up, that would mean you need an additional 25% at the minimum of global production in 5 years from now. Is it realistic? Of course not. That's not possible. Copper market is already very tight, as you have seen recently with an accident in Indonesia at the Carlsberg mine, which only few percentage point of global copper production. The prices for copper immediately shoot up 4% on a day and probably up 10% on a day. So what do you think going to happen if you add another 25% to global demand? Copper prices will go through the roof. Of course, it will not happen in the same way. There will be slowdowns. There will be substitution from aluminum alloys. But it is very clear that any energy transition, slow or fast, will require a very significant amounts of copper, which is nowhere to be found. The copper market is very tight. And that means copper prices will reach a new level. I don't know what's going to be, 12, 15, 18,000. Nobody knows, but it's certainly on the way up. And it's good to be a copper producer at this time.
Yes, very great for you, Artem. And often copper is kind of underappreciated as its importance in the energy transition and doesn't necessarily get the same focus as other components. But when talking about the copper industry, it feels amiss not to talk about last month's Grasberg mud rush incident that led to a tragic loss of life and a full suspension of operations. Grasberg is the world's second largest copper mine, and in 2024 represented 4% of global output. So this incident is expected to result in a cumulative loss of about 600 tons of copper, adding to an already large copper supply gap, which Artem touched on briefly. James, are you able to provide more background on this supply gap? And what are the key blockers contributing to the sustained gap?
Yeah, absolutely. I think it goes without saying that when one of the world's largest copper mines declares force majeure, that the metals market feels it, especially when analysts had already been forecasting a copper supply gap for the next 5 years or more even. That's all coming from that pressure for the global drive for electrification. So any disruption such as this in Indonesia just amplifies and brings an outsized impact on the supply, which is frankly, it's compounding an already existing structural deficit of copper that Artem just touched on. I think those key blockers that have built that gap over the last years really stem from an exploration and development lag. We see new copper mines take 10, 15 years from discovery to get into production. Most recent discoveries are lower grade, more complex systems needing more complicated metallurgy, or frankly, they're in jurisdictions that have higher permitting risk that take longer to get put together. Secondly, the scarcity of capital. We've seen majors have been reluctant to overinvest in upstream or early exploration to start bringing those projects together. That might be starting to change now, but as Harry touched on, majority of investors, they've been demanding capital returns. Impatient money limits growth spending and growth investments. So we just don't see the money coming into that early part of the cycle. Third, I'd say regulatory ESG pressure, increasingly stringent permitting requirements and timelines to go through EIAs and get everything in line. That additional ESG scrutiny that's coming into the capital that's coming and financing these projects, whether it's for development, expansion, or even in the early stage, that additional ESG demand limits the capital that has been able to be put into good projects. Second, or I guess fourth now, geopolitical resource nationalism. You look at Indonesia export bans, royalty reforms in Chile, Zambia's tax shifts, all of these things have compounded and are just making and increasing that pressure and building that gap even farther. It just heightens uncertainty and delays for those investment decisions. So really it stems from capital coming down. And then lastly, these technical challenges. We see declining ore grades. Average copper production head grades have dropped by 70% over the last 30, 40 years. It takes more water, more energy. The things that are going into production now are more complicated. We do see the industry reacting though, like we saw BHP with Olympic Dam. It's a recent example of putting more money in to increase that. But I don't know that the big mega deals or these big consolidations that we see in the sector are going to be able to solve some of those key issues of new supply and be able to bring them online in time to start making a difference for that shortage that we see and is forecasted to keep coming.
If I may add briefly to James, a long list of challenges facing the production side of the copper sector. He mentioned 10 to 15 years from exploration to production. That is very, very aggressive and optimistic. As a way of example, the largest and fastest growing copper mine in the world, Kamoa-Kakula, which is Ivanhoe Mines, it took Robert 27 years from discovery to production. And I echo his comments on declining mine grades. The world's largest copper mine is Candida in Chile, owned by BHP, is 0.5%. So you need to mill and operate on 99.5% waste to get 0.5% copper. That is very, very low, and that's all contributes to the structural deficit, which in case of copper, unlike nickel and lithium to a certain extent, in case of copper, that is driven by demand not only from the energy transition, but from the traditional industry as well.
Yeah, I agree with you, Artem. I do think that 10, 15 years is a pretty aggressive timeline. I think that we can only really base it on things that we see now, but you're right. And with the additional pressure we're seeing, we're probably looking at more 27, 30, even some mid 30-year exploration to development and actual production timelines. So that's not helping solve that problem. So thanks for giving some context.
That's right. And there has been no big new discoveries of massive mines over the last 30 years, other than Kamoa-Kakula in DRC and Oyu Tolgoi in Mongolia. So hopefully James will discover the next big one.
Hopefully, that's the goal, isn't it? But I think it's important to have as much coming online, like even what you're doing in Turkey now, that starts to make and fill that gap too. Getting something into production quicker at a higher grade, lower capex is something that can be financed in this market now.
So lots of challenges, but I'm confident with the people on this call, we're able to solve them. Artem, how do you believe the ecosystem can work together to accelerate supply and meet this surge in demand?
The simple capital markets needs to work and provide funding required for the new projects. And for that, the decision-making of the politicians needs to be much longer than the election cycle. The prime ministers and presidents come and go, but if your timeline to build a copper mine is more than 20 years, you can see 4 or 5 administrations come and go before you actually get from the initial investment to the end product. So I believe in that sense, the good long-term thinking is done by the Chinese, who are thinking 50 years ahead, 100 years ahead, not to the next election cycle. And for that, there needs to be a very conscious attitude toward developing the supply that can power the next advances of human technologies, whether it's artificial intelligence or electric wheels or robotics. If you don't have the basic elements to build those, you're going to be fall behind, and China will fill the rest of the world with their robots, while we are here in Europe thinking, how we can get our additional kilogram of copper out of the ground. So that's very simple.
Thanks. And James, you touched briefly on kind of ESG expectations. We've had a question through from the audience on how can companies ensure ethical sourcing of critical metals while scaling operations. If any of the panelists feel free to add in, but James, I know you just touched on ESG, so you have some of this.
I can maybe start that, and I think there'll be a lot of good input from the rest of this panel. But I think when we look at ESG, it has to be just beyond compliance. It needs to be truly transparent, and it needs to make a positive impact and help good projects advance. So how do we do that? How do we accomplish that? It's a very much live and ongoing discussion, and people are continuing to bring new concepts, but also just to underpin good exploration projects. Like from my seat, where we come into a new jurisdiction and we start to do exploration in the early stage, we actually lead often with an approach of community engagement and where we can actually look at building something. It's almost more important to have that social license and the ability to operate more than it is to have a deposit of high grade and large tonnage. Because if it's locked up in an area where you can't operate, then how can you put it together? And maybe Artem's got some input on that from their experience, as he's a little farther down the stream than I am.
No, I fully agree, James. The fancy words and abbreviations such as ESG, they come and go, but fundamentally over the last few hundred years, the good miners are those who did it for the benefit of the community, that owns the land, that owns the mountains, that fish from the nearby river. And if you're a responsible operator, it goes without saying that any development must first and foremost benefit those communities and don't pollute the environment. As simple as that. And if you're doing it well, the economic benefits will come to the communities, villages, and the jurisdiction overall. And if you try to rob the local people, that will have the opposite effect over time. This is as simple as it gets.
I think just to add to that, Artem, James, as well, is something as simple as powering a mine site that's moving into production, how to get something that isn't a draw on the local power supply. Sometimes mines or often actually they're in quite remote areas, and so a trend that's happening on the ESG side is to build its own power supply with solar energy, wind, etc., that feeds into the mine site itself, but also into the local communities. So again, that's something that a lot of companies are looking at to bring additional benefits to local communities. Power, I mentioned the Ghanaian piece earlier, and so if local communities can start relying on renewable power that's maybe a little bit more localized than the national power, then that's a good step in the right direction. And that's on top of local training as well. I know that James is using local geologists in his mine sites, but all these benefits are certainly helping towards the ESG badge that the companies are now coming under pressure from investors.
In Ghana, Paul, you said you were just down there and you were seeing the government really kind of push to want to build their own resources. And is energy independence and seeing explorers and developers come into the country, is that something that's on the a government's agenda in a nation like Ghana, that they want to see that infrastructure spend come in and trickle through to the locals as well?
Yeah, I mean, that was good. That's a good point, James. And that was very much the message coming from the government. And by the government, I mean the president of Ghana himself stood up and said that, along with the Minister of Energy and Energy Transition. So they stood up and said, look, we've got lots of resources locally. So that's Ghana and neighboring countries in West Africa. We have the ability to upskill ourselves very quickly with investment from external majors in particular. And they very much want to be seen as the powerhouse for West Africa and Sub-Saharan Africa more generally. And they're even talking about exporting excess oil and gas from outside of Ghana to the rest of the world to drive their economy as well. So they're very bullish about that. What they were looking for was assistance and experience on the renewables side to enable them to really upskill very quickly, and not waste the opportunity to start on the right foot. That was key for them. During the week, there was a signing of a letter of intent for 1.5 trillion into Ghana from Eni and Traxys. So that was a very widely trumpeted agreement that was on day one of the conference, which is great to see.
Mhm.
Thanks all. I think the points about the focusing is on long-term value creation rather than seeing ESG as, say, a checklist is something that rings true across sectors. Artem,
Sorry, I just think that's so true. It's, we've gone through, I think, greenwashing. And I'm, Harry's nodding there. I think if investors look at a company that purports to be green, is doing a decent ESG project, investors will see straight through that very quickly.
Yeah, it's much more about focusing on the long-term material risks and opportunities rather than doing it for the sake of saying that you can do it. Artem, you touched on the importance of capital markets in helping us reach that scale copper supply. Paul, are you able to maybe talk about any recent transactions in the critical metal sector? I know 2025 has been dubbed as maybe a recovery year for the global mining IPOs and capital raisings. So what are the key factors investors are currently considering?
I think you're right, and I hope so. I think recent years have been quite lean on transactions in certainly critical metals and the energy transitions space. So, there have been some big ones, and as James was alluding to, the bigger ones generally are people fighting over existing resource. So that would be BHP in Argentina with Filo del Sol. It would be Rio increasing its share in Oyu Tolgoi in Mongolia. Rather than getting involved in the early stage extra copper that we need. Those two were big deals, over 3 billion each, but they were only 2024 rather than this year. So big deals on big companies is fine, but what I'd like to touch on is probably the earlier stage bits and pieces that are really driving the larger companies for tomorrow. And some of them are critical metals, some of them are energy transition pieces. Some of them actually started life as fossil fuels and have transitioned across into renewables, and those sorts of projects are actually gaining some decent traction with investors. There was an announcement today, for instance, on UCOG. It's doing hydrogen in Dorset in Yorkshire in the UK, and it's just agreed a 1 million. So very small, but still quite important in the big scheme of things, for investment into its hydrogen projects, which really kickstart that business. So they're down, they're planning, very early stage, but all this early stage capital needs to be two things. It needs to be patient and it needs to be focused. So that was a really good announcement from today's markets. Last week or 2 weeks ago, we had Serica buying the failed Prax North Sea assets. Again, that shows commitment to the North Sea. It's fossils, but it's all about energy security as well. So I mentioned earlier on in the webinar about baseload and the requirement to have baseload. So I think the North Sea is going to see a lot of consolidation and a lot of I suppose entries into existing wells rather than new wells, which Labour don't like at the moment. But I think that's going to be a busy period for us in 25 and certainly 26 in the North Sea. Turning to critical metals, we've worked recently with Harina coming out of Australia, buying rare earths in Madagascar. Pulsar Helium, another smaller deal, helium in Montana in the US, renewables play. And the one I was referring to earlier, which started life on its IPO on AIM in December 23 as a fossil fuel play in the Irish Sea has transitioned into a natural gas, green hydrogen storage and production facility. That's Energy Pathways in their mesh product there in the Irish Sea. So again, they're at the early stage. They are planning, getting together their necessary mandates. I think they do have support from Labour, which is very good news. And again, coming back to the original piece, if one of Mesh's or Energy Pathways issues with Mesh is to secure some sizable financing, which will run to hundreds of millions in, I would have thought, a time where we might be under a general election. And again, people will probably sit there and see who wins it and what's the mandates coming out from the new government of the day, whoever that may be, before that sizable investment is made very close to UK shores. And I think I may hand over to Artem, because Artem's IPO is obviously RTO is very new. Just talk us through that one, Artem, if you don't mind.
Thank you, Paul. We were born as an operating company a year and a month ago when we completed an acquisition of asset in Turkey for about 120 million, of which 84 was cash and the rest was in shares. 3 months later, we raised $200 million in bonds to finance expansion of the project while continuing to generate cash. I don't operate in a segment of the market where James is, which is much riskier, perhaps more rewarding. I operate in a segment of the value chain where I can more or less predict what the future cash flows will be and what the production levels they are. And I think there is a strong appetite among the investors for the companies with assets which generates cash, because if you look across the smaller size mining companies, very few of them actually make money. By comparison, ACG Metals generates more cash than any of our 4 other copper producers listed in London, other than Antofagasta, obviously, which is 20 billion pound gorilla.
Yeah. Thanks, Artem.
Artem, whilst you have the mic, we have had a related question through from the audience asking you what governance practices have helped ACG Metals maintain investor confidence during these volatile market conditions. So in this past year, are you able to share anything about your governance practices?
Well, I set up ACG Metals from the outset with an independent board of directors. We have terrific INDs, which includes former head of copper at Anglo American, Henny Foyle. It includes Fiona Powles with 30 years of experience in commercial banking in the mining sector. It includes Mark Cutis, who was Chief Investment Officer for Global Situation Group at ADIC, Abu Dhabi Sovereign Wealth Fund, still advises them. And then earlier in the year, the board was joined by enhanced by addition of Mike Pompeo, who is a former head of State Department and CIA in the first Trump administration. So we do have very senior people who are overseeing the company and our compliance with UK corporate governance codes. And I think that is very helpful in establishing the proper public company profile from the very beginning, that we comply with all the rules and regulations and we're fully transparent, and anything you can find about us is on our website. And that is frankly the only way how you can run a public company and have access to the investor funding. Otherwise, you will not have access to these funding opportunities.
Thanks, Artem. Yeah, I think funding seems to be the focus, and often, and rightly so. It is estimated that the industry needs $2.1 trillion in new investments by 2050 to meet net zero emission targets. But often, mining of critical metals is often excluded from green funds. Harry, what do you think needs to be done to stop this critical sector being overlooked? And do you think the role of critical metals in the energy transition is understood by the market?
I think it's a very broad question there, and so I'm trying to distill it into a few. I think, is it understood by the market? I think to a certain extent. Again, we've talked a lot about copper today, and that is obviously the metal du jour, and probably for many days to come as well. I think that is well understood by the market. I think the role of others, I mean, is less well understood, and also we've touched on this a number of times today. It's this approach to investing in this need for sort of patient capital and a long-term investment horizon. If you look at things like nickel, cobalt, where the markets are in oversupply, again, there doesn't seem to be the appetite so much for investment in there at the minute, despite the fact that long-term, there doesn't seem to be much doubt that the demand for those products is going to go up significantly in the future. Whereas, and unlike copper, they don't necessarily have the traditional industries to fall back on that will require it now, or indeed data centers, others, where, that's why, copper seems to be so strong. So are they understood by the market? I don't think all critical minerals are created equally in that respect. I think if you look at platinum group metals, for example, if you want green hydrogen, platinum group metal chemistry is fairly fundamental to your ability to actually create green hydrogen. But again, I don't think that's particularly well understood by the market. I think people are looking at the end uses and looking for sort of short-term gains rather than perhaps an ability to invest in that longer term. In terms of green finance and people become more open to investing in mining resources, I think I'm optimistic there. Whether or not that will be achieved, I mean, there will always be those that are particularly dogmatic on it that you probably won't convince. But if you look to a parallel with probably the defense sector currently, which was blacklisted by a lot of ESG and green funds in recent years, however, following the invasion of Ukraine and this growing recognition that, if defense is fairly central to our ability to create a sort of sustainable and just society, you've seen a number of funds now be willing to invest within the defense sector that weren't previously. And I think going forward, there needs to be a better, and I think this is improving, understanding of the fact that if we are going to get to a successful green energy transition, or however you want to phrase it, that is going to have an enormous demand on resources. And we need to ensure that the companies doing it are doing it sustainably, as cleanly as possible. But these are carbon intensive industries, a lot of them at the end of the day. Drilling something out of the ground needs power, and some of that will, for the foreseeable future, probably be diesel around things. But if we are going to get these resources, that you can't have one without the other. And I think there needs to be a sort of, and I think there is coming a growing realization of this sort of symbiotic nature between the two. And I'm optimistic, but I mean, there will always be, I think, some dogmatic people that won't ever view it as a potentially green investment. But, I think we are seeing more and more funds sort of looking that way and, starting to see it as a greener investment and or a green enabler, as well as an industry that is itself greening itself.
Thanks, Harry. I especially like the parallels between the defence sectors. I think that's a conversation that has come up more and more recently about the connectivity between defence and sustainability. So hopefully we see a similar approach with mining finance. Paul, are there any regions London can take learnings from in order to scale mining finance to the volumes required?
I think there is the answer. If we look at the exchanges around the world, we've got four principal ones, to be honest with you. Obviously ourselves in London always flag up that we've been very supportive of the mining sector over the years, but the leader is the Canadian TSXV. Stat there, I believe, is 40% global mining equity is raised across their companies. They got over 1,000 mining companies, raised 7 billion last year. So that's the leader. It tends to be, I'll be careful here because we do have a Canadian on the call. They tend to be at the smaller end, which is fine. We moved down to the ASX in Australia. They tend to take companies from a little bit from startup through to say, early production, mid-tier companies, gold, lithium, rare earths they've been looking at, particularly attractive to the Asian investors being that side of the world. And then you get to the big players listed in the US, much larger scale companies, so Freeport, McMoran, Newmont, they're listed there, which leaves London in the middle, really, which historically has been African focused, again on the time zones. And it's moved away over the years from juniors and explorers into more sure capital, more, as Artem was saying, a capital that people can see and they can get returns on quite quickly, which also goes back to what James was saying about patient money and Harry. So you look at all these things and you think, well, where can we get capital? Where can London learn from? And I think it's not a mining thing, it's not a renewables thing. I think it's an individual thing in the UK. And the LSE know all about this, and there are plans afoot to try and get more individual capital into the London Stock Exchange. And what I mean by that is my personal money, Harry's personal money, pension money to go into UK companies who then have the assets overseas to go and mine in. If you compare that to the Canadian side, their big mining conference, PDAC, is twice the size of the one down in Cape Town, and that's because people wander around, individuals, mom and pops, investing cash in companies that they like to speak to face to face. So they like the sector, they have an allocation personally of cash that they spend each year, and the companies want to go and see them. If you see enough of them, then you get some cash into your project. I'd like to just invite James to have some comments on that, because I know that James has been around those markets recently with Cayenne. Just some thoughts on that, and then possibly move to Artem. Artem, I don't know your journey to London and how you ended up on London. Did you look at other exchanges to see a destination? Perhaps James first.
Sure. I think having been active in all of those 4 major markets of public equities, I actually did an analysis earlier this year comparing the liquidity and number of issuers and financing done across all of the UK, all the Canadian markets, the Australian market, et cetera. I mean, we do see larger market cap companies in the UK take about, let's call it 3 times as much money down on average in a year in financings when you do it on a per issue basis. But we see that growth capital come into the Canadian and the Australian markets, and a good market, energy and metals in the North American, in particular in the Canadian markets, just trades so well. Liquidity is one of the biggest factors that we see in being able to access that capital, because a lot of these funds, patience is one thing. There still needs to be a liquidity threshold to be able to actually get in and out and have a market that is recognized. And the ultimate on that is, of course, the US. But for explorers seeking early stage capital in the world that I work inside of before it passes into production where Artem works, we see ASX and the Canadian markets being the best place for that speculative early stage smaller capital that comes in. London is much more of a producer, financial driven market, multi-production or multi-asset portfolio producing. It's really tough and it's part of that journey. And I'm really curious how Artem landed on London as a place to list in. I've taken companies public and been part of that process across London, Australia, and Canada numerous times. I think we've done over 100 RTOs and IPOs now. And it's an interesting decision to land on. And I think there's a lot more influence than just access. A lot of it's driven by your capital. Where's the money coming from? What do they want to see? Which exchange has the right compliance? Which exchange has the right, integration with the jurisdiction you might be operating in? In Artem's case, London makes a lot of sense. Turkey, time zones, capital makes sense for that stage of project. So curious, Artem, what your journey was like to get to London.
London is a good market for the companies which are not exploration, not developers, but are producing. And for the jurisdictions, whether it's Turkey, Eastern Europe, Central Asia, or Africa, that is also very familiar. one other big advantage of London is a very deep knowledge base, both among the investors and advisor community, given the presence here of the big mining companies traditionally passed from Billiton to Xstrata to Glencore, etc. There has been a number of growing companies through the years in the London market. And for me personally, the good example is Xstrata, because that's exactly what we're doing, but focusing very much on one sector, which is copper.
Continue to focus on the UK capital markets reforms, which are very much focused on increasing both institutional and retail investor participation. Conscious of time, so James, I'm going to ask you to answer this very, very briefly, but if you could just touch on what are the key emerging differentiators in the mining sector and how should miners be adapting their strategy to reflect this? Quick 30 seconds answer would be great.
Sure. I think, well, those challenges and those differentiators aren't unique just to copper and critical. They do span all of it, all of the metals and all the mining sector. I think some of the big things that you'll see emerge is going to be more about jurisdiction, operating in an area where you can get it permitted in reasonable timeframes, with logistics to actually bring a project to market in a short time frame is key. Higher grade, lower capex operations, I think, is going to be a big focus for the next few years to start to pinch out that supply gap. Access to patient money outside of traditional equity funding, government support, OEM offtake agreements, that emphasis on ESG just beyond compliance is going to be a huge differentiator. And people investing in growth, getting money down into that early stage of the cycle, seeing those projects come up to pass them into producers is important to me.
Right, thanks, James. Nice and concise. And maybe just to finish off with Harry, if you could give one piece of advice for our corporate audience here today, how should companies be communicating their strategy to access these investors? Mute. Harry.
Sorry, I knew someone would do it. I'm ashamed of me. I think, look, it's fairly simple on this, and we've touched on a lot of it today. I think, compliance is a key point. Transparency and clear, credible targets, fundamentally, say what you're going to do, make it credible, and give a roadmap to how you're going to do it. And the reason for doing that is because it's going to make you a better business and you're committed to operating the right way, rather than it being a sort of sticker that you're trying to do. I think it really is that simple.
Thanks, Harry. And that brings us to the top of the hour. So I think that's all that's left for me to do now is to thank today's panelists. I think just how much we managed to pack in with an hour shows how interesting this topic is, and really welcomed your valuable insights today. I would also like to thank our audience for tuning into the webinar, and we'll remind you that this webinar will be made available on demand on the Spark page. Thank you for joining and have a nice day.